Let's continue our discussion on the global financial crisis. At this point, we know that the seeds of the GFC were sown even before it hit stride in 2007. As you may have heard in the media or debated with people you know, there were many causes of the crisis. However, in today's lecture, we will discuss four main causes of the crisis that most economists tend to agree on. We will study each of these causes in depth, so let's dive right in. Excessive risk-taking and the misperception of risk in the financial sector was considered one of the key causes of the GFC. This cause was somewhat fueled by a long period of benign economic and financial conditions, known as the Golden Decade. This period, especially in late 1990s and early 2000s, was characterized by strong and stable economic growth, low and stable inflation rates, and relatively low interest rates. At the same time, the housing markets in the US and other countries were booming, and house prices grew strongly. This period of prolonged optimism and complacency caused market participants to take excessive risks and borrow heavily and imprudently in the financial markets. Fueled by low interest rates and the expectations that house prices would continue to rise, households purchased houses and took mortgage loans in record numbers. The ratio of U.S. household mortgage debts to house values increased significantly, especially in the 2 years preceding the crisis, even with rising house prices. Many of these borrowers were those that in other circumstances might not be qualified due to poor credit records and histories. These borrowers could even get the loans and purchase houses with very little or zero deposits. Hence, many of these mortgages issued during the period can be considered as subprime mortgages. On the supply side, banks and other lenders were willing to issue those risky mortgages and loans. They expected that house prices will continue to rise and that the favorable economic condition will go on forever. Another reason for this willingness is due to a financial innovation called asset-backed securities, or ABS. As the name suggests, these securities or shares are backed by some underlying assets and can be traded in the financial markets. When these securities are backed by mortgage loans or assets, they are called mortgage-backed securities, or MBS for short. Why were ABS or MBS critical for the build-up of the crisis? Well, with this innovation, after issuing the mortgage loans, lender could simply lump these mortgages together and securitize them. This MBS could then be sold and traded in the financial markets. Once this happens, the original lenders are no longer responsible for these mortgages and are free from the risk of defaults and financial losses. The ability to securitize and trade the mortgage loans caused these lenders to be imprudent in assessing the loan applications and their risk of defaults. Subsequently, many of these loans were issued to subprime borrowers. As we can see here, there was a significant increase in the volume of ABS issued in the US in the years preceding the crisis. Many of these ABS were MBS, in other words, they were backed by mortgages. These MBS were bought and held by various types of investors: pension funds, insurance companies, mutual funds, individual investors, and even by commercial banks themselves who had issued the individual loans. Many of these investors wrongly thought that MBS were safe assets. Therefore, there was a widespread misperception of risk in the financial markets. In reality, these MBS were quite risky due to the inclusions of subprime mortgages. What the investor did not know was that a downturn in the housing market might lead to a large number of defaults. This can therefore cause these assets to be distressed and decrease in value. And that was exactly what happened during the GFC. A second factor responsible for the GFC was the increased leverage of borrowing by banks and other financial institutions and investors, fueled somewhat by low interest rates globally. The low interest rate made borrowing cheaper. Hence, banks and other investors borrow money in the financial markets in record number. They did this mostly to finance their purchases of higher yielding assets, including ABS and MBS, in search for higher profits. These borrowings were usually short-term borrowings, which had to be renewed frequently. They are therefore risky borrowings, as investors may not be able to refinance their borrowings during a credit crunch period. At the same time, it may not be possible to sell the MBS assets quickly during this period. Therefore, these assets may have to be sold at deep discounts in a fire sale. Again, this is exactly what happened during the GFC. The quest for higher profits led banks and other investors to neglect this riskiness. Worse still, a lot of these borrowings and investment were done within a so-called shadow banking system. That is, they were conducted by a group of non-bank, non-depository financial institutions, such as mutual funds, hedge funds, and investment banks. These institutions normally do not take deposits and hence are not subject to various regulations and safeguards intended for commercial banks. For example, these institutions are not subject to minimum capital requirements and have little restrictions on the type of assets they can hold in their portfolio. And this brings us to the third primary cause of the crisis, the lack of regulation of the financial system. In contrast to deposit-taking commercial banks, there's a lack of regulations and oversight of the shadow banking systems and hence the overall financial system. In fact, regulators and policymakers at that time did not fully recognize the immense size of the shadow banking system and the extent of the riskiness in the financial system. They could not have anticipated the impending crisis. Finally, many economists agreed that the interconnectedness of the global financial system was also responsible for the immense scale of the GFC. It turns out that many banks in other countries were also holders of large amounts of U.S. mortgage-backed securities and were therefore exposed to the U.S. market implosion. For example, many banks in the euro area suffered huge losses and had to rely on government support to survive. Many went into bankruptcy and were simply dissolved. The global linkages of the financial system had made this crisis that originated in the US truly a global financial crisis. So there we have it, 4 of the main causes of the global financial crisis. These 4 factors significantly contributed to the scale, breadth, and depth of the crisis. As depicted in the previous real GDP figure, the crisis has significant negative impact on aggregate economic activity in various economies around the world. Given the impact of the crisis, how did the policymakers respond? See you in the next lecture as we discuss the countermeasures they implemented to respond to the crisis.